So guys, want to welcome everyone to this month's webinar. And as you can see, this is to do with the buy-to-let loopholes. Now, there's a lot of people that have been asking over the past number of months, what's the loopholes, or are there loopholes, and what can people do to actually save money in regards to obviously tax and income. So look, in regards to the loopholes side of things, what I'm going to hopefully get over to people today is the potential tax savings that you can have, because let's be realistic, most of the loopholes that are out there, thanks guys for getting back to me, no echo, Louis, I think it might be just yourself in terms of that echo. So yeah, the most important thing about loopholes is it's not some clever little trick that no one knows about. It's things that are out there in the public domain. It's tax savings that you can sort of take control of and take advantage of. But importantly, it's about knowing what those tax loopholes are. So in terms of getting the best out of our investments, it isn't just about the price that you pay and the return that you get. So many people, they come in, they buy a property, or they've purchased a property in the past, and they simply get 6-7%, whatever it may return them. And then, of course, they then go through the normal process. They then start to pay that money back in form of service charge, management fee, ground rent, and of course, mortgage. And they're left with X amount at the end of the month, and they take this as the norm. However, the more and more people that we deal with, the more and more people we put them in touch with, certain companies where you can do capital write-downs, little things like that. And importantly, it's that which can really start to save you some big money going forward. And I'm going to show you how to do that on this call. So let's head in. As I say, in terms of what we're going to assume for the first part of this webinar is that you've purchased a property, or you're about to purchase a property, and the price is what it is. Doesn't matter whether it's 100,000 or 500,000, that's the price. It's a given. The cheaper you get that price, the better your investment is going to be. But again, you don't need to for me to tell you that. That's a very basic analogy of what we need to do. We need to get the price down as much as we can, enable us to get the best yield on that particular property. But then as we sort of as we head forward, what we've got to do is look at any losses. So those of you that had properties in 2019, 20 and beyond, did you make any losses at that particular time? Did you have tenants that didn't pay? Or did you have any tenants at all? Because if you did make losses, you need to get onto your tax advisor and you need to carry these forward. So for example, if you had £2,500 worth of losses due to a tenant not paying, or extra costs or extra cleaning costs, and you made £10,000 in this coming year, you need to offset those particular losses that you made. So many people, and I would probably say 60 to 70% of the clients we deal with, they don't actually deal with an accountant. So they try and do things themselves, and they don't carry forward any losses. Now, just carrying forward the losses on a £2,500 loss, if you're a 40% tax rate payer, you're pretty much paying £1,000 extra there that you don't need to pay. So 100% as a basic rule, it's the first thing you've got to do is carry forward those losses, because so many people don't. And as I said to you, it is no exaggeration. 50, 60, 70% of people that we speak to, they and ah when it comes to, did they carry the losses forward? And of course, did they have any, do they have an accountant? Just double check the chat, guys. Better. Okay, thanks, Lee. So guys, just checking the chat there to make sure everyone can hear. So that's the first rule, guys. Make sure that those losses are carried through. Secondly, when we come to our particular development that we buy, what kind of let are you doing? Are you doing short-term lets, or are you doing long-term lets? Because there are ways on each to get the property to be as efficient tax-wise as possible as you can do. So let's assume that we're going to do some short-term lets here. Now, the best way to drive down that tax bill is by doing short-term lets, because you have all the advantages of a limited company when you do short-term lets. So, for example, the first things that you can do in terms of the tax savings is you have to meet certain criteria. Now, that criteria to qualify for a short-term let has to be furnished. So you can't get away with an unfurnished let. It has to be furnished. So my advice to you would be to get a really basic but good quality pack of furniture. We've had clients who have bought cheap before and it's been cheap, and what happens is you constantly have breakages. We actually had someone who had a new sofa in there, the legs were as thin as you like, client sat on it, broke the leg, and of course it creates more hassle for you going forward. So you want to get good value property. We've also had clients that have paid over the odds. They've paid 10, 15,000 for a furniture pack on a one bed, which is well over the top, let it out. But the problem is, on the back of that, what then tends to happen is you have higher wear and tear, which again you can claim back, but you're paying well over the odds for what you need. Typically, I would say on a good one bed property, you need to spend around about 4,500. On two bed, 5.5, potentially 6, depending on the area. And that will include everything. That's pots, pans, TVs, cutlery, the lot. But as I say, they must be furnished to qualify. Secondly, it must be available for 210 days of the year. So if you've got it advertised and you only advertise it for 3 months of the year, it's not going to qualify. So you have to have it advertised for 210 days of the year. And in terms of letting, it has to be let for 105 days. If you don't get that property let for 105 days of the year, it isn't classed as a short-term let property. So again, we have to make sure it's let. That's why I would always use professionals, whether it's ourselves. We have Skylet, obviously. There are other good companies out there like Pass the Keys. And the reality is they can let your property as a short-term let. Importantly, going forward as well, is that you cannot let it to the same person, the same tenant, for more than 31 days in succession, or 155 days in total. It then gets classed as more of an assured short hold tenancy. So what we have to do is we have to make sure that the property is, clarifies and quantifies these 4 criteria to qualify. And if you do, then, as I say, the most important thing is we can then go to the next stage, which is how we can claim back, and we can use all the loopholes available. Now, one of the first loopholes is, and this is what I would say 5% of our clients that we deal with know about. The rest of our clients, we have to get them on board this. But when you're doing a short-term let, and we know short-term lets have been tough during COVID times, but they're now coming back, is we will put you in touch with a capital allowance company, and they will write down everything. And I mean everything. Everything that if you turn that house upside down the way that they describe it, whatever doesn't fall out, they will claim back for. So your kitchen, they will turn around and say this kitchen costs X amount. So if that kitchen costs, for example, £10,000, they will write that into a capital allowance. Your bathrooms, your tiles, your wiring, your pipes, everything that can need or potentially does need work down the line, they will claim back for. They typically say that 25% of your property can be claimed back for. So let's say you've spent £200,000 on your property. They feel that they could probably write down £50,000 of that. Now, if they can, that means the first £50,000 that you earn is tax-free. They will get a certificate from HMRC. They give that certificate to you. And then the moment you put in your end of year tax return, you put in your certificate, and as long as it meets that criteria, you can claim back those capital allowance. So that's the first thing that I would do. Bearing in mind, it might take you 2 years to make that 50,000 back, or maybe even 3 years to make that 50,000 back. The reality is that could be 3 years of tax-free income that you're getting just from your capital allowance. So that's the first thing that you need to do. And again, that's one thing that we can put you in touch with. Secondly, claiming back the interest on your mortgage. Now, we know that the government tapered the relief on this down to 0, where you couldn't claim back the interest on your traditional buy-to-lets, but you can claim the interest back on holiday lets. So if you're paying, for example, £5,000 a year interest, again, claim that back, guys. That's a lot of tax on a 40% tax rate payer. That's a lot of tax that you're going to be paying. So make sure that you claim the interest back on that. And again, this is why we say use a professional to buy, use a professional to let, and use a professional accountant to do your tax return at the end of the year. So claim back that interest, because the reality is all of these things, you might think, oh, it's only £500 here or £1,000 here, but do that over 10 years to each of the loopholes that we're going to go through today. And you're probably going to have 60, 70,000 that you could have claimed back that you would have wasted if you didn't. So definitely be claiming back that interest on your mortgage. Wear and tear. Again, the wear and tear, for example, the wear and tear isn't just in your furniture. It's not just on your settees, on your armchairs, on your beds and things like that. It's everything. It's, for example, if you need to claim wear and tear on your flooring, chips in the wood on your kitchen worktops, whatever it may be, lost cups. And I know it sounds ridiculous to claim back for £2 or £3 here and there, but again, all of this, guys, adds up. It is just about keeping meticulous notes and meticulous receipts is what enables you to claim back the most. And also wear and tear, guys. Let's say, for example, that you've got to go and do something in your property. You may have to drive there. So if you're going to claim back mileage, train fares, whatever it may be, again, we had a client who did none of this. We just asked him if he could just do this for 1 year and forget the capital allowances that we managed to claim for him. But in terms of all the other stuff, and the interest of his mortgage, the wear and tear, and train fares alone, he spent £800 on train fares getting to and from the property. Again, 40% of that he saved. So there's a lot of money that can be saved just from, as I say, your wear and tear on your property, but also your travel costs and your train fare. All furniture, all appliances, whether you're paying money to have a phone in there, whether you're paying money for TVs in every single room, again, all of that kind of stuff needs to be claimed for. And you'll be surprised, a good accountant will ram this tax bill down as low as they possibly can for the end of every year, and it will save you potentially over a period of 10, 15 years. It could save you tens of thousands, maybe a lot more than that, especially if you've got the capital allowances. It could go into hundreds of thousands if you've got a good sized property with a big chunk of capital allowances there. So these are things that you have to do, but be really meticulous, because that is what is going to be the difference between saving and not. Repairs as well. Again, quite a lot of the time people pay repairs out of their own funds, their own money, and they don't claim back for it. They lose the receipt. So again, all of these repairs, which might just be a tap repair, a tap leak, a toilet repair, whatever it may be, you need to save every single receipt that comes in, because again, you don't want to be paying tax if you don't have to. And the reality is that by the time you get to the end of 5 years, the tax that you've saved could actually be a deposit for your next property. The end of 5 years, again, the tax that you save in the next 5 years could be another deposit. So suddenly you've got 3 properties there when you would actually only had 1 if you didn't actually take advantage of these tax breaks. And then moving on to expenses, as we've covered slightly already, you travel to and from the property. Are you eating out as well? So for example, if you leave early in the morning and you have breakfast and then you have some lunch and then potentially some dinner, similar kind of thing. You need to save those receipts, because you may have spent £100 on food throughout that day, and the reality is that's £100 that you can claim back off your tax bill. So what you guys need to do is save every single receipt possible. Other examples, as I say, you've got phone calls associated with your property. We've had clients who have claimed back for magazine subscriptions, legal fees, accountancy costs, advertising fees, management fees. All of these fees, all tax breaks and all can all be deducted from your gross income. And as I put here, they may seem trivial, but even if it's £3 to £4 a day, it's going to be well over £1,000 mark by the end of the year. These are just minor costs, let alone the major costs that you're going to have throughout the year. Also, stamp duty relief. Now, look, the reality is that the majority of you, we've now missed that opportunity, apart from the ones that we got wrapped up last week, especially we got it wrapped up by Thursday, and a couple of you missed a day. But the reality is that we had this stamp duty relief. But look, again, apologies that this webinar was done in 2 stages. The first stage, we could have had the stamp duty relief, but unfortunately now we don't. But there will be advantages and moving forward. The reality is that a lot of people who had their property that they had in their personal name, they could have taken advantage to transfer it into a company name and taken advantage of that stamp duty relief. But unfortunately, guys, that's now gone. But there are still going to be some advantages going forward with the tax side. But what you can work out is, even if you've got to pay stamp duty, even if there are some stamp duty costs to be had in regards to, if you've got £200,000 property and there's some tax to pay for stamp duty, it might still be better put it in a company name over a 10-year period. What you need to work out, you need to sit down with your broker or sit down with an accountant and meticulously work out year on year what your saving will be. So you will have a cost initially. So if you're transferring your £250,000 property from your personal name into your company name, there will be a stamp duty fee that you have to pay on that. But if that fee is negated by all the savings that you're going to have over a 10-year period, it's worth doing now, because the chances are stamp duty may increase over the next decade. So you need to take advantage of those things now whilst you have the chance. but it's all about planning. It's not about saying, well, stamp duty is going to cost me £5,000, I can't be bothered. If you save 15,000 over a 10-year period, of course, it's 100% worth doing. So meticulously work out what the cost of is to change from my personal name into a company name. And then, of course, the cost of saving. And that saving will come in you claiming back interest on your mortgage. You'll have more control over what tax you pay, because obviously when you pay corporation tax, you've got more control over who you pay. For example, you may employ yourself, you may employ your wife, or you may employ a family member. And that's ideal if you're a higher rate taxpayer, because you could employ a family member who's on a lower tax rate. And of course, you can get the money back that way. So that's a legitimate way of keeping your tax bill down. And of course, there's potential inheritance tax savings. If you have shares in the company, you can pass those shares on. There are certain inheritance tax benefits there moving forward as well. So they're things that you need to think about transferring your property from a personal into a company name. And of course, other things that I've mentioned there, you've got wear and tear on furniture, furniture costs as well, phone bills, electric bills, company cars. A lot of people, what they've done recently is they moved over to a company name, and after a couple of years, they bought themselves an electric car because it has a very low benefit in kind. And actually, they got rid of their car that they had, and they put the car into their company name, and they saved a lot of money because it's a full tax write-off if you buy an electric car. So again, all of these things need to be discussed with your accountant, but there are so many things to take advantage of, which, as I say, the majority of people, they don't even look in depth at how they could actually save. Even the cars sitting on your driveway, you could potentially get those into your company name and save a good chunk of money. I think personally, guys, that we've really only touched the surface in some of these particular little mini tax savings and mini loopholes. You really need to speak to an accountant who will know things far in depth than what we do. They're obviously fully qualified. They will know your personal circumstances in great depth. And importantly, guys, as I say, it's 100% worth speaking to them. So most accountants will happily set up a free call or a free Zoom call, enable you to try and maximize their knowledge. And if you feel comfortable with them, it's worth using them, because if you use a professional each stage, I've got no doubt you'll reap the rewards further down the line. So this has been recorded, guys. So we're going to put this is going to be up on our website over the next sort of 24 hours or so. If there are any questions, feel free to ask in the chat box, guys. We've had some people come through to us already on the chats. One person has asked in terms of the area, does the area depend on if they can do short-term lets? No. When the property is judged for short-term lets, you never get asked where is it. It doesn't matter. As long as it meets the criteria that we said at the beginning, which is the 210 days available, let for 105 days, fully furnished, and not consecutively for 31 days or more for the same person, then it meets the criteria. It doesn't matter whether it's here or in the Orkneys, up in Scotland, it makes no difference at all. So look at the conversation here. So yeah, in terms of the savings that we've gone through there, guys, they are savings for short-term lets. When you put it into a company name, though, those savings on things like the interest on your mortgage and the wear and tear and your furniture, that's actually on normal traditional buy-to-lets as well. So the first slide, let's go back a couple of slides actually, guys. Let's head back. So in terms of the short-term lets, this was all the short-term lets savings. So if you qualify for this just here, let's say these four pieces of criteria, this is all what you can claim back on. However, moving forward, if you actually put the property in a company name, this is actually for traditional lets as well. So this isn't just short-term lets, this is traditional lets. You can still claim back your interest, more control over the tax you pay, potential inheritance tax savings, and furniture as well, and obviously wear and tear. So that is both on short-term and normal traditional 12-month lets as well. What else have we got here? Do you have to announce whether the property is short-term and long-term at the beginning? That's a really good question. So what we will do is we will let that for you, and it will be done when you do your tax return. So when you use your accountant at the end of the year, you will put it through as a short-term let, because what you don't want to do is announce that it's going to be a short-term let, and if it doesn't work, then we're going to switch over to a normal a normal traditional or normal buy-to-let. But that's something that we can take care of for you. And again, we can when we let for you guys, we will, for example, if you're an overseas client, we will speak to HMRC. We will do what's called an NRL1 form, non-resident landlord 1 form, and we will do the same on the short-term let side of things as well. No problem. A couple more questions here. Should each property be in a separate company? Again, that's a really good question. Well, with the new corporation tax rates coming in, which are going to be, if you, off the top of my head here, guys, I might be wrong. So, but if you make over £50,000 profit a year, you will pay more corporation tax. My advice to people would be to work out how much your property is going to make, and how close you're going to get to that £50,000 profit threshold. Typically, most people could put 2 or 3 properties in until they reach that threshold, but you need to work out the relationship between the threshold and the actual property in question. So it will become advantageous if you get close to that £50,000 mark, but you don't have to. But it also depends on what your plans are moving forward. For example, are you planning to give these to your children? If so, it may be easier to put them in separate names, so you can give one to one child, one to another. And again, probably definitely worth speaking to your accountant in regards to this, because I've got no doubt about it, they will have a better idea of your structure and your pay and your tax rate than what I do. A few more questions here, guys. Look. How can you minimize tax, not paying it? How can you minimize tax with a limited company, i.e. not paying income and corporation tax? Okay. So yeah, obviously we can't advocate tax avoidance, but you can't. But you know, the reality is you're going to have to pay tax. It's just about how to pay as less as possible, right? So what we want to make sure, and what your accountant will do, is he will let you know the best way to do it. For example, let's say that in corporation tax you earn £20,000 in your company at a tax rate of 19%, but your personal you earn £40,000 that year. Well, if you earn another £10,000 from your company, you're going to still be taxed at that 20% mark on your personal income. The moment you go over the £50,000 limit, or whatever it is, you start going into the 40% bracket. So your accountant may well say to you, look, you're best to keep the extra £10,000 in your company, pay the 19% on it, and then potentially keep that for a rainy day, or pay yourself down the line, or pay a family member. The reality is you can't. You're going to have to pay some form of tax. You cannot pay zero tax on your profits. It just won't happen. But again, your accountant will know your personal circumstances, and he'll be able to juggle things and claim as much back as possible, and advise you on either keeping it into your company or paying yourself. Again, what other people do, I've got one client, he literally earns money on his property, and he can transfer £40,000 a year, I believe he said, into his pension. So he puts it all in his pension. So there's certain things that you can do, because that classes as you know, a tax write-off for him. So there's certain things that you can do dependent on your personal circumstances. Can you pay yourself a monthly salary? Again, yeah, you can pay yourself a weekly, monthly, yearly salary. It's entirely up to you. What tax you pay, again, I don't know. That depends on you personally. But yes, if you want to pay yourself a salary on that, then yeah, a lot of people do. A lot of people have themselves or their partners on their books, and they pay themselves a regular salary. So no problem. A few more questions, guys. Do all expenses have to have a receipt, or can cash expenses be claimed? Yeah, again, that's a really good question. Guys, the reality is the more, you might have an accountant who lets a few things slip, but the reality is you don't want to be doing you know, cash, because the problem with cash is just not traceable. You could theoretically put anything through. You could say, you know, £500 cash because I've got a limousine to my property, or whatever it may be. My advice is not to do cash. You want to make everything traceable, especially in this day and age. There's no excuses to do cash. Everything can go on a card. If you've got a company, you can have a company card, or you may have a bank account, which is, you have a segregated account for your property, and you have a separate card for that. My advice is, yeah, don't go down the cash route. It would just lead into problems down the line. Also, NRL1 form, not sure if you spoke about this in the video. No problem. An NRL1 form is what's called a non-resident landlord form. So if you're based overseas and you don't do one of these forms, we legally have to take out your tax at source. So let's say you get £10,000 in, we have to take out that tax at source. However, if you fill in one of these forms, it means that we don't. We can transfer the gross amount to you, and then it's down to you to do your tax return at the end of the year, basically. It's as straightforward as that. Alex, I've seen that you've raised your hand a few times, and I do apologise. I'm going to say I don't know how to enable you to speak on this. So, Alex, let me see if I can. Alex, oh, Alan, sorry, not Alex, Alan. Alan, can you talk? Can you hear? Alan, you're on mute if you. Hi, Alan.
Sorry, I'd raised my hand before I sent that question.
Oh, sorry.
The limited tax. I wasn't saying that I wasn't willing to pay tax. I was just saying, is there ways where I didn't have to pay double tax?
I see. Yeah, it's tough, Alan, because the reality is if you finish your end of year accounts in your property company, and you pay your 19% on that, whatever it may be, and then you of course use that same money to pay yourself, you're going to pay tax on it as well. So yeah, it's hugely frustrating, because what you don't want to do is you don't want to pay 19% and then 20 or 40% on the same batch of money, essentially.
Yes.
So again, an accountant will always have the best way of doing it. Even with, look, it's my Flambeau, this is my company. What I try and do, if I'm honest with you, I try and spend as much money as possible, because there's always something to spend it on. So when it comes up to my end of year, I think, right, how much marketing can we do? What can we spend it on? Otherwise, you're right, I'm literally doubly paying. I'm paying it when it hits the company corporation tax, and of course when I pay myself, or I pay my wife or whoever it may be. So yeah, no, I fully understand that, mate. And yeah, apologies. I wish I had a better answer for you as well.
Yeah. Change the government, maybe.
Yeah, exactly. Yeah, maybe that's the answer, mate. No problem. Right, Alan, I don't know even how to. I might have to put you on mute, Alan. Apologies. There you go. Lower hands. Right, guys. So I think there might be another couple of questions here. Do all expenses made from a personal account have to be claimed every month, once a year? No. I claim once a year. So I give it to my accountant every single year from my personal properties. I give it to the accountant, and all the receipts, I have it in some form of order. Otherwise, I'll be honest, the money that I'm saving, in tax, I'm paying him to organise. But I try and put it in monthly receipts or monthly slips for him. He then goes and deals with it, and he deals with it at the end of the year. Let's have a chat here. I already have 2 properties in an overseas company. If I transfer a controlling interest to my son who lives overseas, does that have any effect on the tax to be paid? Good question. If you transfer a controlling interest to your son, there's potentially a stamp duty liability there. Again, we'll have to speak to a lawyer in regards to that, and I'm more than happy if you I'm going to do, actually, guys, I'm going to change this page to my email address at the end so you can contact me. But yeah, there may be a stamp duty liability there. For example, if you've got 100% of the company and you transfer 50% to him, you may have to pay 50% stamp duty based on the price of the property. So there might be that. In terms of, I think there are 2 parts of that question. So look, sorry. My son who lives overseas, would that have any effect on the tax paid? So as I say, there might be a stamp duty, and if there is stamp duty, because he's overseas, you might have to pay an extra 3% or a couple of percent stamp duty, sorry, because overseas clients now pay an extra couple of percent on their stamp. But in terms of the income side of things, well, no, if he does an NRL1 form, he has up to the allowance of whatever it may be, I think 12,800. And then of course, anything over that, he will be taxed on. But again, depends on where he's based. Do they have dual tax treaties there? Can he, is he okay to claim the free allowance here, but not paying tax where he's domiciled? So yeah, there's certain things that, again, an accountant will be better answering on that for you guys. And I think that's it, guys. Yeah, I think that's it. Well, look, it's been an absolute pleasure. Thanks for everyone for getting involved and asking questions. And Anything you need, please feel free to send me an email, give us a call, and I look forward to speaking to you all soon and see you on the next webinar. Take care. Bye bye.